What if I told you the single biggest mistake you can make with your money is trying to be smart? We're taught that to win in the stock market, you need to be a genius. You need to pick the next Amazon, time the crashes, and outsmart every shark on Wall Street. But what if that's a complete lie? What if the data proves year after year that the real secret to getting rich isn't a high IQ, it's being dumb? In this video, I'm going to show you the psychological traps that make smart investors go broke, reveal Wall Street's dirtiest secret backed by decades of undeniable data, and give you a simple, 3-step dumb investing plan that has been proven to outperform the so-called experts. Stick around, because what you're about to learn could be the most profitable and relaxing financial decision you ever make. First, let's get our terms straight. When I say a smart investor, I'm not talking about some Wall Street wizard with a supercomputer. I'm talking about us, the person who thinks they can beat the market. Let's call him Active Alex. Alex is always on the hunt, glued to his phone, constantly refreshing his portfolio. He's a hands-on investor, which means he's making a ton of decisions. He's chasing the winners, piling into stocks that are already soaring. He's trying to time the market, selling when he thinks a crash is coming, and buying at what he hopes is the bottom. He's picking individual stocks he believes will be the next big thing. Problematic. He's doing what feels smart, what feels proactive. The problem is, his own brain is his worst enemy. This is where we dive into a field called behavioral finance, which is the science of why we make totally irrational money decisions, even when we know better. Vulnerable. And smart, active investors like Alex are the most susceptible because they make the most decisions. First up is the most dangerous trap, overconfidence bias. After a couple of good picks, our brain starts to think we're the next Warren Buffett. We overestimate our own skill and knowledge, believing we are superior to others. This illusion of control leads to excessive trading, which racks up fees, and taking on way too much risk, thinking we can't possibly lose. Next, we have the trap of loss aversion. Psychologists proved that the emotional pain of losing $100 feels twice as powerful as the pleasure of gaining one. We hold on to our losing stocks for way too long, desperately trying to avoid realizing the loss. This is called regret avoidance. Contrasting, 2. We sell our winning stocks way too early, terrified that our small gain will vanish. We're so afraid of losing that we literally sabotage our own ability to win big. And finally, the most powerful trap of all, herd mentality. When we're scared or unsure, our brains are hardwired to look at what everyone else is doing and just follow the crowd. This is the psychological engine that fueled the GameStop and meme stock frenzies. We see a stock going to the moon, and the fear of missing out, FOMO, kicks in hard. We buy high, caught up in the hype. Then, when the mood shifts and the herd gets scared, we panic sell low to avoid more losses. Our ancient survival instincts literally program us to buy high and sell low, the exact opposite of what you're supposed to do. Okay, so these brain traps feel real, but what's the actual, real dollar cost of trying to be smart? For over 30 years, a research firm called DALBAR has been tracking exactly this, and their annual study is devastating. They compare the returns of the actual market, like the S&P 500, to the returns of the average real-life investor, and the gap is staggering. Over a 20-year period, while the S&P 500 returned about 3 per year, the average equity investor only earned 0.90. That gap, almost every single year, is what I call the smartness tax. It is the price investors pay for trying to be clever. It's the cost of market timing, performance chasing, and letting fear and greed drive your decisions. It's the mathematical proof that our bad behavior has a bigger impact on our portfolio than the market itself. It's the story of people like the Reddit user who, after doing mountains of research on a complex trade, lost 97% of his money overnight. He said it himself. He would have been in a much better position by doing the dumb, boring shit. So if Active Alex is consistently losing the game, who's winning? Meet Passive Patty. Patty's strategy is so simple, so hands-off, it feels dumb by Wall Street standards. Pillar number 1, buy everything. Instead of trying to find that one winning needle in the haystack, Patty just buys the whole haystack. This is called index fund investing. An S&P 500 index fund is a single investment that lets you own a tiny piece of the 500 largest companies in America. Apple, Microsoft, Amazon, all of them. You're not betting on one company. You're betting on the long-term growth of the entire US economy. It's the ultimate form of diversification and the perfect antidote to overconfidence. Next, pillar number 2, never sell. Patty's timeline isn't next month, it's next decade. This is the famous buy and hold strategy. By holding for the long term, she unleashes the 8th wonder of the world, compound interest. exponential. Her money starts making money, and then that money starts making its own money. This snowball effect is what builds true generational wealth. Holding on also dramatically lowers her transaction costs and her taxes, because long-term capital gains are taxed at a much lower rate. This is the cure for loss aversion. The rule is simple. You don't sell, so you can't panic sell at the bottom. Okay, let's take a breath. If this is already starting to make sense, if you're tired of the stress and the constant checking of your phone that comes with smart investing, do me a quick favor. Hit that subscribe button and turn on notifications. I put out videos just like this one designed to make building wealth simple, stress-free, and accessible to everyone. Thanks. Now let's get to the final pillar, the secret weapon. Pillar number 3, automate it. This is the secret weapon that ties it all together. Patty removes her greatest enemy, her own emotional brain, from the equation. She uses a strategy called dollar cost averaging. She sets up an automatic transfer to invest the same amount of money on the same day every single month, no matter what the market is doing. Counterintuitive. This simple, mechanical process forces her to do what active Alex is too scared to do. Buy more shares when prices are low, when they're on sale, and fewer when they're expensive. It automates discipline and completely removes market timing, fear, and greed from... Okay, the theory of dumb investing sounds good. It's simple, it's logical, it's stress-free. But what does the data actually say when you pit the smart guys against the dumb strategy? This is the part the big Wall Street firms, who charge you hefty fees for their expertise, really don't want you to see. For decades, S&P Global has published the 𝗕𝗶𝗯𝗶𝗃 scorecard, the official, undisputed scoreboard for this debate. Over a single year, about 65% of professional fund managers, people with PhDs and six-figure salaries, failed to beat a simple, dumb S&P 500 index fund. Escalating. But look what happens over time. Over 5 years, 87% of them fail. Over 10 years, more than 9 out of 10 professional managers underperformed. And over 15 years, it's a near total wipeout. 93% of the smart money lost to the dumb index. And it's not just S&P. Morningstar's research shows the exact same devastating trend. Less than a quarter of all active funds survive and outperform their passive rivals over a 10-year period. So why does this happen? 2 reasons. 1. It is incredibly difficult to consistently outguess the collective wisdom of the entire market. And 2, the absolute killer? Fees. Active funds charge high fees for all that genius trading, often 1% or more. Passive index funds, run by computers, have minuscule fees, sometimes as low as 0.03%. That difference seems small, but over decades, it's a massive handicap that active managers almost never overcome. The data is crystal clear. The cheaper the fund, the higher its odds of success. The dumb investor wins because they have an insurmountable cost advantage from day one. Okay, enough theory. Let's make this real. This is for educational purposes, not personalized financial advice, but it is a well-established framework. Step 1. Open the right account. For most people in the US, a Roth IRA is a fantastic place to start because your money grows and can be withdrawn in retirement completely tax-free. Step 3. Set it and forget it. This is the most critical and the hardest step. Set up an automatic recurring investment from your bank account into that fund. The amount is less important than the consistency. Put it on autopilot and then walk away. Don't check it every day. Don't listen to the scary headlines. Trust the plan and let the system do the work for you. For decades, we've been sold a myth that investing is a game of intellect, but the evidence is overwhelming. The real game isn't about being smarter than everyone else. It's about being more disciplined than your own worst instincts. Inspiring. The dumb investor wins because they understand that their most valuable assets aren't a hot stock tip or a complex algorithm. Their most valuable assets are time and consistency. They win by playing a different game entirely. You do not need to be a genius to build wealth. You just need a plan and the discipline to stick to it. So start your simple, boring, dumb investment plan today. Your future self will thank you for it. Thanks for watching, and I'll see you in the next video.